Hello and welcome to Capital Ideas TV. I'm Mark Bunting. Helios Medical Technologies is developing a potentially revolutionary and disruptive treatment for brain disorders. We featured the company as a cover story in our Capital Ideas Digest last October. Helios is getting very close to getting Food and Drug Administration or FDA approval, and if that happens in Q1 of next year, the stock could take off. Here's our conversation with the CEO of Helios Medical, Phil Deschamps. Phil, we spoke several months ago when we did a cover story in our Capital Ideas Digest on Helios Medical, but we don't want to presume or assume that our subscribers and our viewers know exactly what Helios Medical does. So describe it for us.
Sure. Well, it's nice to be here with you again, Mark.
Great to have you.
No, thank you. Helios is a company focused on neurological health, and we're a development stage company that is developing an asset called the Portable Neuromodulation Stimulator, or PONS for short. And it's a device that, when it's combined with physical or cognitive therapy, seems to help relieve neurological symptoms. And that's quite profound because people with neurological symptoms of disease or trauma, like traumatic brain injuries or MS or Parkinson's, unfortunately, once you're afflicted with those conditions or have chronic symptoms, there's nothing much you can do. So our technology offers hope for those people, and we're at the development stage, and here in a couple of months we'll know the answer.
Now, one thing that's really fascinating about this device and what your scientists and your team have discovered is that the link between the tongue and the brain. So describe that for us.
Yeah, so it's really sometimes you sort of look at things going backwards and you go, gosh, I wish I'd have thought of that. But when you look at it going forward, it's really kind of interesting. The tongue is tied to the brain with 4 major cranial nerves. In fact, it's the organ that's tied to the brain more closely than any other. And so the scientists that developed the technology wondered why. Why are there so many pathways to the tongue? And it's when they started to experiment. The first experiments were actually to try and use the tongue as a low resolution screen for vision. And you have plenty of really fun videos to look at on YouTube when you look at people who see with their tongue. And that was the confirmation that the path can actually be, or the path from the tongue to the brain can actually be used. And then it sort of evolved to more rehabilitation and looking at how could we trigger the brain to respond to stimulus that would allow it to remodel itself, and that's what ultimately the scientists tried, and lo and behold, in a bunch of anecdotal cases, it seemed to work. So now we're involved in real science to try and determine if we can prove it scientifically to the satisfaction of regulatory authorities, and we'll know the answer in a couple of months.
Can you give us a little demonstration here of the PONS device?
Sure. It comes in 2 pieces. The first is what we call the pulse generator, and remember I said it was always a combination of physical therapy and stimulation. So we designed it to fit right around your head like this, which means that you can do any kind of exercise, walk around or anything like that. And then the tongue array, which is a quite sophisticated piece of electronics, delivers the electrical stimulation to your tongue. And you put it on the front third of your tongue. Your tongue is innervated by more nerve endings than even the tips of your fingers. And then those electrical impulses are actually translated to what the body and the brain recognizes as motor neural impulses, the same that come up your spine and into your brain. And it seems to be the combination of those 27 million impulses coming from the PONS, combined with those that are localized in your brain by working on what you have a deficit from. So if I have a balance disorder, for example, I would do balance exercises while I'm doing this. So the brain gets flooded with information, combined with the localization of what part of the brain you're working on by doing your balance exercises, and the two things combined seem to help the brain find a way to reorganize itself to accomplish what's been damaged by disease or trauma. So that's fundamentally how this works.
In our previous conversation, one of the lines that stands out for me is you said you've patented the hell out of this thing. So tell us about the patents and how important they are for the company.
Sure. Well, look, any development stage company, a lot of the value that's built into these companies are on the patents, and we have 53 patents in 3 specific families. And Dr. Alder at the U.S. Patent Office is our patent reviewer. I hope she doesn't mind being mentioned. She's essentially knows the literature very well, and so far we didn't have a single patent in June 2014, and now have 53. So quite exciting.
You're keeping the doctor busy. So tell us how big this market is potentially.
So we want to be internally consistent when we think about this. Our first indication, Mark, is going to be for balance disorder related to mild to moderate traumatic brain injury. And so let me define it under only those conditions, and then I'll speak about some other ones that we haven't really quantified. So the traumatic brain injury market in Canada and in the US, in the US, it's about 5 million people that are walking around with chronic symptoms of a traumatic brain injury. Of course, we're for balance disorder, so you've got to look at about 40% of that population. So at the price that we're considering the device, it's about a $5 billion addressable market for us in the US, for which we're going to be the first and only indicated should we make it through the FDA gauntlet. And then, use the old 10% rule for Canada. So roughly 500,000 people across the country here in Canada, and the same dynamics. So that's a very large initial addressable market. Of course, when you look on the consumer side, that will be in the future because we really feel very passionately about making sure that we validate the science behind this medically. But when you look at the height of the baby boom now in the U.S. is 67 years old in median age. There's 78 million people going through that period. So the addressable market potential becomes kind of crazy when you start looking at that potential population on the human performance side. But again, we're focused on the medical development at this stage. So those are the kinds of numbers that we're talking about. Our second indication will be related to should we make it through the clinical trials in MS, and then we'll look at Parkinson's, stroke, and certainly the numbers get astronomically large when we start looking at those potential conditions.
Right. One thing you said in our previous conversation is that quote unquote the gloves are off when you get FDA approval, so you can move on to those other kinds of treatments. So speaking of the FDA, you've got first in class designation. What does that mean? Does that give you certain advantages? And I guess last part of that question, how close is the FDA, if you know at all, to making a decision?
Yeah, so let me give you the timeline. So right now, our pivotal trial, we should be recruiting our last subject here within the next week, 10 days. So very, very exciting for us. It's been a long road. Then it's a 5-week trial. So that trial should end, so the trial will end sometime in mid-August. Then 4 or 5 weeks of data analysis and data cleanup. So sometime in mid-September, we should know what the data looks like. And then obviously we'll be submitting to the health authorities. It's important to note, though, that both for Health Canada and the FDA, the submission is more than just your data. It's your quality systems, it's your design history file. They're, in fact, for a non-significant risk device, they're almost more focused on those kinds of aspects because they already deem, if it proves out to be the case, that the device is safe. So now it's all about, can these people produce it in a way that allows that safety to be conferred to people through the... So we're working very hard with our manufacturing development team, and we plan on making our submission to the health authorities, and we'll do 4 at the same time. We'll do FDA, we'll do Health Canada, we'll do CE Mark in Europe, and we'll do TGA in Australia. And we plan on doing those sometime in the fall, in the 4th quarter. That, based on what we understand the timelines, should mean that sometime in the first half of next year, we could potentially be cleared for this should the data show, the data and our manufacturing data show that we're deemed to do.
Neolithium is sitting on one of the biggest and purest lithium mines in the world in Argentina. We featured the company in March, right around the time of PDAC, as a cover story in our Capital Ideas Digest. Neolithium is hoping to start production in 2019 to start feeding what could be insatiable demand for lithium to be used in lithium-ion batteries and, in turn, electric vehicles. Here's our conversation with the CEO of Neo Lithium, Dr. Waldo Perez. Waldo, it's estimated that the electric vehicle market by 2024 will grow something like sevenfold. Are these the numbers that you're hearing?
Absolutely. Look, I was in a conference with the Volkswagen representative. They provided a presentation. They want 30% of their vehicles electric by 2025. They are one of the largest automotive companies in the world. So their forecast, not ours, is more aggressive than most people in the market is aware of.
Now, when we've talked in the past about lithium supply and demand, you've used a cell phone analogy. Could you give that to us again?
In one car, you need 25,000 iPhones to actually drive a car battery-wise. So if each person that just own an iPhone would actually buy a Tesla or other electric car, well, you need 25,000. Okay. more right. Times more battery. Just to give you an idea in numbers, okay, we have done a very important discovery here, okay? Well, the world would need like one discovery like ours every year if that analogy would sustain. So lithium is here, but it's not just the regular commodity like copper, iron, gold, etc. No. Here we are finding a use that will consume a lot of lithium, a lot more than have ever been consumed. So any new discoveries is extremely relevant to the current market.
Bloomberg had a story recently which said that no matter what Tesla does and no matter what the Gigafactory produces, China eventually will swamp the market with lithium-ion batteries. Do you think that's going to be the case, and is that ultimately good for your company?
Yes. I mean, definitively Tesla is very well known in North America, and rightfully so. However, it's only one Gigafactory for the US. Mercedes-Benz is building a similar one in Germany, and China is building today 7 like Tesla's factories. So you can see that even Tesla being really large, it's no more than 10% what people is actually building in other places of the world. Now those factories are built based on technology, on the need, on the electrification of vehicles, but there is not yet a clear answer to where the lithium is going to come from. So of course, current producers will have to crank up production to their means, to wherever they can, but new discoveries are absolutely necessary here.
So tell us about the recent drilling results and what you found, and was it sort of better than you expected?
Yes, actually what we, in previous discussions we have together, I show you that we have found on surface lithium lakes and lithium salars, and this is very unique. There's not many places with lithium lakes. There's only one actually in the world, which is in China. So we found another one, but in South America. These lakes, it's the same brine that you find in the salar, but it's actually in a lake. The lake is important only to show where it is. It's like Payback Hill, but only 2 or 3% of the entire deposit is actually hosted in the lake. 97% is in the porous space of the salar, and it goes down around 100 meters in depth. Okay, what we have found is basically a total of 1.3 million tons lithium carbonate equivalent in fair resources, and measured and indicated 700,000, which makes a total of 2 million. You know, when you add them together, just to have an idea, the measured and indicated would allow us to go in production for 20 years at a rate of 35,000 tons of lithium carbonate per year. That would be like the second or the third largest mine in the world. And we have already, with 1 season of drilling, 20 years of reserves. So the discovery is very significant. We could continue drilling and make it bigger. It wouldn't be a wise use of capital, simply because we already have 20 years of it. But what is important is that it's the 4th highest grade project in the world, and it's the 4th. The others are in production already. Okay, so we are there. It's the 8th biggest in the world, and has the lowest contaminants of any known project.
So give us a timeline, 17, 18, 19 into production.
Well, look, we completed our resource estimation. The economic assessment is coming in the next quarter. That is the third quarter, 2017. After that, in next year, we are starting the piloting, and we complete piloting means the pilot plant that will produce lithium carbonate. We are today evaporating the ponds, that is evaporating in the ponds. So the ponds are actually getting to the concentration. Just to have an idea, it requires about 1 year to concentrate the brine to the right level, okay? And so next year we will complete the feasibility study, which is 2018. Mm-hmm. And in 2019 we will start construction. So this is very near term. Having said that, we discovered that in December 2015. So we got to this point from discovering the field to secure the property, create the company, IPO, it was an RTO, but that is go listing public, right. Finance, the further financing, and get to the point now in 1 year and 6 months. So this is a race. And it's the same race that the automotive industry is on to create electric cars. And it's the same race that the battery manufacturers are actually building batteries with a source of lithium that they still don't have. Mm-hmm. Well, we're on the same race to actually get there.
So they're all running parallel at the same time. So in terms of financing, what's interesting is that some lithium companies will be dealing with, say, some of the lower echelon investment bankers. You have some big names involved.
Well, actually, when this discovery, believe me, rocked the world of the lithium industry. Like, many people came to us. And when we presented this to institutions like BlackRock, JP Morgan, Royal Bank of Canada, M&G, McKinsey, all these institutions immediately get us to support. And they actually completed just recently a $25 million financing. So when you see our institutional ownership, we really have the premium brands in the investment community of the world vested on us.
I've seen the number 300 million to bring this into production from various analysts. Is that accurate?
Yeah. I mean, these mines, and it will depend on the size. We have this project is very big, so we could be bigger in terms of production than some people predict. But we are working on our financials to do that. But in general, just to have an idea, another company, a company I was involved before, Lithium America, mm-hmm. have released a feasibility study for 25,000 tons lithium carbonate per year with around $450 or $500 million. So that would be like a range which is reasonable because it was presented by another reputable company on a similar, resource. Our resource have some particularities that are very beneficial, like the low impurities and so on, but it's going to be on the range.
And lastly, Waldo, do you have a message to shareholders?
Yeah, look, the message that I have to shareholders is the following. The big institutions supported us. They finance us at $1.10. Well, people now, the regular guy, can get into our stock not too far from that price. Mm-hmm. So if the biggest banks in the world have backed it up with millions of dollars at current price, the small investor should be aware of that. Due diligence has been done for them. So now is the time to get in.
Some insider activity for you now. This is when we look at officers and directors and the various insider buying and selling that they're doing with the companies that they're involved with. We'll start with Colabor Group. We featured this as a cover story back in October. Fabrice Taylor, one of our contributors, thought it was a good turnaround story. He turned out to be right. Look at the run here to about $1.40, bumping its head at that level several times. Then it had a quarter that was somewhat disappointing. The stock sold off, and then big consolidation after that. What's interesting, though, is that the vice chairman of the company, Mr. Briscoe, has bought more than 400,000 shares in recent days, so clearly he sees value here. Some more insider buying for you with Immunovaccine, where the chief financial officer has recently increased his stake at these levels by 93%, the CEO by 10%, and the chairman of the company increasing his stake recently by 80%. Organic Garage is a grocery retailer. It's newly public, it's small, but is growing. The company plans to quadruple its revenue by 2019. And the founder of Organic Garage has grocery retail in his blood. He's fourth generation in his family. Here's our conversation with the founder and CEO of Organic Garage, Matt Lurie. So Matt, clearly you have grocery retail in your blood. Maybe you could give us a little sense of the background going way back to your great-grandfather and your history with grocery retail.
Yeah, my family immigrated here from Poland prior to World War II and settled in downtown Toronto. And like most immigrants, opened up a small business for the family. It was a small groceteria selling primarily produce and dairy with some select grocery. It was called Good Bombs. And so it stayed in the family. I'm a fourth generation grocer myself. So it's in the blood.
So tell me about the mission at Organic Garage. You founded it in 2005. Before that, you were a franchisee with Subway. So what would you say your main mission is with this company?
Our main mission is to bring the public healthier foods for less. We felt that there was a high margin being charged on organics and natural items that was unnecessarily being charged. And we wanted people to be able to eat healthier. So we set up a model that allowed us to sell products at aggressive prices through our stores.
You partake in what you describe as smart buying. How would you define that, and how does that help you lower prices for consumers?
Well, part of our business model is a smaller format store. So that means that we have a highly rationalized offer. So we don't over-skew categories. Our goal has always been to carry the number one and the number two that spends to be like the number one, and then we infill with some local brands. So that helps with our negotiation with our vendors because it gives them a lot of exposure in our stores. As well, we're starting to buy a lot more direct, so we're cutting out the middleman and able to pass those savings down to the consumer. And the volume buying that we're doing and centralizing through our warehouse also gives us additional savings that once again we can pass down to the consumer.
You also made a crucial decision early on, which is maybe unusual for a smaller company in the retail area, and you built a distribution center. What went into that thinking, and how does that help you?
Well, I knew that it would be a core building block for our future growth. We saw a lot of opportunity, just like I just mentioned, about buying direct, and we want to centralize that purchasing into one location. It is unusual for a two-store chain to develop that, but once again, I knew the potential for growth in the future, and I didn't want to go back at store number 5 or 6 and try and reintegrate a distribution center into our model. So I felt it was important to develop it very early on.
Now you say that consumers can get lower prices at Organic Garage as compared to Whole Foods, compared to even the bigger ones, Metro, Loblaw, and so on. You've touched on it a bit, but how do you do that consistently?
Well, the big thing for us is also even our operating model. So our operating model is very lean. We don't have service departments, so there's not excessive labor. And most companies like the Whole Foods of the world have to pass on those operational costs to the consumer through higher pricing because they have to pay for that labor somehow. For us, we've stripped all that out, and once again, we've passed that down to the consumer and giving them everyday affordable pricing anytime that they walk into the store.
So Amazon buys Whole Foods for nearly $14 billion recently. When you heard that news, did you think, uh-oh, or did you think, hey, that's pretty good for the sector?
I think it is a good thing for the sector. I think it's a shot in the arm for bricks and mortar when a large internet-based company is trying to acquire a bricks and mortar retailer. I think for us, in the industry, I think a lot of people are concerned maybe about what Amazon might try and do to the industry, but it's not easy to change somebody's fundamental business model. Whole Foods has established themselves and created a model that requires certain pricing. It's not easy to suddenly change that and make drastic changes to their business model.
Are you strictly bricks and mortar, or do you have a digital strategy as well?
We do have a digital strategy, so that's something we're going through a lot of development right now. So our third location is opening shortly. We have 2 more scheduled for next year. Once we get through some of that upfront expansion, we do have a plan to access digital and online that I think will be very good for our business model.
Let's talk some numbers here, Matt. So in your most recent fiscal year, you had about 15 million in revenue, correct?
Yep.
And you want to basically quadruple that by 2019. How do you get there?
Through store expansion. So we've had an overwhelming amount of interest from the landlord and developer community. I think all landlord and developers are looking for unique retail businesses, especially with what's been going on with bricks and mortar. They want something different to offer their consumers, and especially food. Food is a very attractive tenant for any landlord or developer. So we've been overwhelmed with interest from specifically downtown, but across the GTA. So I think there's a lot of runway for us to grow bricks and mortar 2 to 3 stores a year very easily, and it's just keeping up with that growth and that demand.
And how are you cashed up from the market, basically?
We're in a good position. So I think combined with kind of the lease structures that we've established with some of our landlords through inducements and stuff, it's going to help fund the capital expansion that you need while you're building out the stores. So I think we're okay for the next little while, and I don't, we won't have to access the market, too quickly to be able to fund our next round of expansion.
So let's say you get the 60 million in revenue by 2019. You are launching a private label business as well. Can you estimate basically or predict what percentage of your sales will be from private label at that time in 2019?
I don't know if I can estimate, but I think private label is important for any grocery retailer to have as an augment to their business. It allows us to once again pass savings down to our consumer. Our private label was built around value and providing additional value to our consumers in core commodity style categories. And especially because we have a highly rationalized offer, it gives us an opportunity to showcase our private label more so than in a conventional grocery retailer. So I think there's a lot of opportunity for growth there, especially in the kind of a whole meal replacement solutions and stuff, because there's not a lot of alternatives in the natural and organic side for frozen meals and things like that. But we have a lot of co-packers that can produce for us to, fill out our offer inside our stores.
Would you say one of the differentiators for you would be the fact that, and for investors as well, would be you have very high sales per square foot, basket size, that what people pay as they walk out the door. Your margins are higher than most as well. Is that what makes you stand out in a way?
I think, when I think about the things that insulate us from our competition, I think it's 4 key components. And I think it comes down to brand, the environment in which we sell in, our product mix, and our value proposition. I think those 4 things combined allow us to create some separation from our competition. And the name in the game in grocery is scale, so growth will help a lot in terms of us accessing more competitive costing and driving costs out of the system to make us incrementally more profitable. So I think from an investor standpoint, I think those are the things that they should be excited about, because grocery can be very competitive. So it's how you differentiate yourself. And those 4 things, brand, environment, product mix, and our value proposition, really helps us stay ahead of the curve.
You've been running this since 2005, but you're recently a public company, which has got to be different for you. You're doing interviews like this and so on. So what would be the message to a shareholder or a potential shareholder that may look at your company going, I'm not sure, I'm not sold yet? What's the message to somebody who may be on the cusp of buying in?
I think from a differentiator standpoint, like I mentioned, our brand, environment, product mix, and value proposition puts us at a different level than our nearest competitors. So that's first and foremost. I think also from a growth perspective, we have so much opportunity in the next 3 to 5 years to consistently grow through new store locations. I think that's what propels earnings and profitability that is attractive to new investors or existing shareholders. I think our recent uplisting to the TSXV as well brings a certain liquidity to the market that's attractive for an investor compared to maybe some other exchanges. So I think all those 3 things combined should mean it's attractive for somebody looking at our company to say, hey, I think I'd like to invest with these guys.
Some 52-week highs and lows for you now, starting with Gildan Activewear. About a year ago, the stock was at much higher levels, and then it sold off, but it's really taken off in the past several months. In fact, lately, breaking out to higher levels, breaking above the $41 mark, and we're looking at 52-week highs on Gildan Activewear. Conversely, we continue to focus on energy stocks when it comes to 52-week lows. We'll start with Athabasca. This company slowly grinding lower, breaking through $1.10 recently at 52-week lows. The other one here is Neolithium. This company is similar trajectory, heading lower and breaking through the $1.70 level, so 52-week lows once again for some energy shares. From the heart of the financial district in downtown Toronto, that's our show for this week. I'm Mark Bunting. Now be sure to subscribe to our Capital Ideas TV YouTube channel. That way you get notified when new episodes are available. And if you never want to be the last to know as to what's going on in the markets, you want to subscribe to capitalideasresearch.com. You'll get our weekly Capital Ideas Digest and our morning note. Thanks a lot for watching. Thanks a lot for investing like a pro. We'll see you next time.